Today, I will be telling you everything that you need to know about a mortgage. So if you're someone who owns a home right now or is planning on buying a home in the next few years, this video will definitely help you to learn more on the finance side of things when owning a home. I will also be talking to you about two different ways on how you can save money in interest over time and also help you pay off your loan ahead of schedule. For those of you who don't know me, my name is Ryan Banks and my channel is about financial tips and tricks that you can bank on. And if you hit that subscribe button, this will help you learn more about your own finances and make sure that you make good financial decisions for you and your family. First things first, what is a mortgage? Well, a mortgage is you getting a loan so that you can be able to purchase a home. So for example, if you get or purchase a $500,000 home and you put 20% down on that home, which is $100,000, you will get a mortgage for $400,000. Now, the reason why mortgages have lower interest rate is because you're backing it up with an appreciating asset, which is a home, which means it increases in value over time. But if you compare that to a line of credit, usually that's a bit more riskier because people tend to buy depreciating assets so the value decreases over time, like a four-wheeler, a couch, a boat, you name it, it's most likely a depreciating asset. So that's why you kind of see lower interest rates for homes. And it's also for a longer period of time, where line of credits, it's more for a shorter term. Now, if you don't put 20% as a down payment on your home, this will trigger you to get mortgage insurance. And financial institutions make you get mortgage insurance just because it makes it more likely that you're going to default on your loan. And the reason why I say this is because if you get a 25-year mortgage from someone who put 20% down, and same thing if someone put 5% down, the mortgage payments will be a lot higher because there is a lot more principal to pay. So the most common mortgage insurance you can get is CMHC. While we're on this topic, you need a minimum of 5% of the purchase price of the house to be able to buy the house. You need to also remember that there are some other cash adjustments that you need to have, which are lawyer fees, if there's a property tax adjustments, and then other little adjustments that you may not know of. The other thing too is, if you buy the house for the first time, you're going to need to fill that house. So that means maybe buying some furniture or some little tools and odds and ends. So you need to think about those things before buying a house. So I know people say it's 5% minimum, but there's always additional costs associated with that. Now, before I get into the two different types of interest mortgages, I want you to know the term principal. So principal is the amount of money that's left to pay off on your loan or your mortgage. So in my previous example where you bought a $500,000 home and you put a $100,000 down payment, on the closing date or on day one of your mortgage, you have a principal amount of $400,000. Now, when you make payments, there is a principal portion and also interest portion. So the principal portion will reduce that $400,000, and the interest portion is the amount of money that you need to pay for the borrowing costs of your mortgage. When you sit down with your mortgage broker, they will ask you what type of interest do you want on your mortgage. And the two options are a variable interest mortgage or a fixed interest mortgage. So at the closing date of your house or at the date that you renew your mortgage, you will take the specific interest rate at that date and you will be locked in at that interest rate for the next 5 years. Now, for a variable interest rate mortgage, that will depend. If the interest rates go up, then you're going to be paying more, but if the interest rates go down, then you pay less. So the general rule of thumb is variable interest rate mortgages are cheaper than fixed rate if you compare them at the same interest rate. The next decision that you will need to make is the frequency of your mortgage payments, which are monthly or biweekly payments. And I'm just going to tell you, biweekly payments will help you save interest over the long term. And the reason why I say that is because monthly payments approximately equates to 24 biweekly payments. But because there are 52 weeks a year and you make biweekly payments, you get 26 payments. And when you calculate the interest on each of your payments, because you're making more frequent payments, it will help reduce that second payment of the month a little bit, I guess a little bit more, so you pay a little bit less of interest. And when you think about this over a 25 or 30-year period, this can equate to thousands of dollars. Now, I want to share with you my own experience when I bought my first home a year ago. And the reason why I find this so important is because buying a house is probably the biggest purchase that you will ever make in your life. And you want to do this in a way that's really good for you financially, for you and your family. And this is kind of the reason why I made this video, is just so I can share my knowledge and my tips and tricks so that you can make better educated decisions. Now, about a month before I was ready to start looking at some houses, I went to 3 or 4 different financial institutions to look at the lowest rate possible. And I ended up going with a different bank that I'm with for my checking and savings account. And there's nothing wrong with that, because at the end of the day, you want to get the lowest rate possible, because that means that you're paying less in interest to the bank, and that can mean thousands of dollars over the length of your mortgage. Now, the reason why I want to do the pre-approval is that it locks that specific interest rate for the next 6 months. And I needed that time to be able to go find a home. Now, when I did pick whatever bank I want to go with, I sat down and got the pre-approval done. And what's nice about a pre-approval, which happens, or I guess the clause that happens into most banks, is if the interest rates go down for whatever reason, you're able to get that lower rate at that closing date. But if not, and if the interest rates rises, you're locked in at that rate at the pre-approval date that you did it at. When we got our successful offer, we set up our mortgage with a fixed interest rate, which means that we locked in our rate. And the reason why we did that is because interest rates were rising at the time. What we also did is bi-weekly payments so that we can save a bit on interest on the mortgage over the period of our mortgage. And it also helps because we get paid bi-weekly, so we're able to cover those 2 additional mortgage payments when we get paid those 2 extra months of the year. So the other thing is, yes, if you don't get paid bi-weekly, if you get paid bi-monthly or monthly, you should not have a problem paying that extra 2 payments bi-weekly, just because if you have a hard time, that means you're in a house that you maybe cannot afford, or it's really close to that. A good comfortable range for your mortgage payment versus the amount of money that you bring in every month, I think should be around 25 to 35%. Now, if you want to pay off your mortgage a lot quicker, in my case, 7 to 10 years quicker, what I do, and since I bought my home, is I've done more and more research, and I started making recently, about 3 months ago, additional principal-only payments. So the reason why I do this is because it will help me save on interest that I pay for my mortgage over time, and also when I renew my mortgage, the principal amount will be a lot lower, meaning even though if the interest rates are high at that point in time, I won't be paying as much interest. And it's a lot better than just paying a whole big chunk at the end of the 5 years, because if interest rates are really low for you right now at a fixed rate because of the COVID rates, when you renew, they could be potentially 2 to 3 times higher. And that significantly increases your mortgage payments. So by doing a little bit here and there, it will definitely help you over the long term. And in my case, I am paying off about 1/6 of a mortgage payment every month. So I know it's a little bit, but it will add up over time. And it's a lot better than making a big chunk, like I said, at the end, where you need to renew your mortgage. So in my case, this will probably help me save 7 to 10 years off of my mortgage so that I can be more financially free later down the road. Buying a home is probably the biggest purchase that you will make in your life, and you want to make sure that you do this financially smart so that you can help you and your family reach financial freedom when you retire. One thing that you want to make sure is that you don't have a mortgage by the time that you retire, so that you can have financial freedom and enjoy your life when you are retired. So today, I went through the differences between a fixed versus variable interest mortgage. I also went through the difference between bi-weekly and also monthly payments and how bi-weekly payments help you. And I also showed you some tips on the pre-approval where it can save you on interest, and also the benefits of doing additional principal-only balances. Now, I just want to thank you for watching today's video, and if you have any questions whatsoever, write them down in the comments, or you can email me at ryanbankscpa@gmail.com.